Investing is just like everything else in life if you want to be really good at it. You must achieve failure to succeed, whether it's failing a bench press attempt, losing something in your sport, or just general loss in life, because the general takeaway from loss is you learn from why you lost and you correct that mistake and you come back and you win. The same thing is said with investing, and today I'm going to be going over the biggest losers in my portfolio so far. Now, this is a sequel to the video that I did with the biggest gainers in my portfolio. Feel free to check that one out. And everybody at some point is going to lose an investment. Some more than others. But it's important we can learn our lesson and do an objective takeaway from it. And today, I'm going to be sharing the top 5 biggest losers in my portfolio by percentage amount. Now, these are all stocks, and I'm still convicted in long term, and I'm going to be sharing where I could have possibly messed up making the investment, whether I regret buying, so on. If you'd like this level of transparency that you can't find in some other specific finance channels not to be named, feel free to subscribe and turn on post notifications. Let's get into the video, though.
Hello, I like money.
First company that's the 14th largest holding in my portfolio, and I'm currently at a 27% loss on the company, is Disney, stock ticker DIS. Now, Disney's a very, very interesting one. I first started my Disney position around today's prices in 2020. Then it traded up near $200 in the 2021 market, and since then it has absolutely come crashing down. Some are saying that Disney is in a content kind of a dry streak here, and I actually agree. They have been nowhere close to reproducing the kind of quality of content and blockbuster films that they did in the 2010 era. Endgame was honestly the last time I thought they made anything kind of good and worthy that I noticed a lot from an outsider perspective. But now it appears that we're in a generational streak when it comes to bad content for Disney, and the stock price is reflected on that. But I have been dabbling back in my Disney position as of recently, and here is why. For me, the last earnings report for Disney was a really good quarter and a big sign in the positive direction. 2024 was a make or break year for Disney, and honestly would probably be the more indicative year of whether I'd be holding the company still or not. Yes, I could sell out at a 27% loss, lose some money on the position, and move on if the company did poor this year. But I am seeing some really good movements in the right direction. The parks business is awesome, it is undisputed. I've also heard that the cruise line business is going to be ramping up once again. 5 years ago, Bob Iger was one of the biggest, undisputed, greatest CEOs of all time, but all of a sudden now he's one of the most hated and shit on CEOs. He got Disney out of hell once, and I believe he can do it again, but this time it's a lot different, it seems. Hopefully Disney can get back on the blockbuster track with their new film Moana 2, which appears to be really good. Thank you to Dwayne "The Rock" Johnson. And Toy Story 5, which is set to release in a few years. But overall, I think that Disney's content from the 2010s era has definitely declined. And I hope you're kind of making the bet at this point that it's going to be rejuvenated in the 2025 and beyond. From what I've heard from my co-host Fiscal and the Cashflow Kings Live, go subscribe. The X-Men 97 series is apparently pretty decent, and that's one of the newer creations that they've been making. But Disney is set to produce $7 billion in free cash flow this year, which is the absolute huge thing that I took away from the earnings report. And maybe I just grew out of my content loving for Disney, but it appears other people are, and if they generate $7 billion in free cash flow this year, that's absolutely huge, and it's a recovery play for sure. I also love that they're buying back a huge amount of shares and also bringing back that dividend as well. I've been dabbling in Disney as of recently, nothing wild whatsoever. I put my toes back into the pond, but definitely if it were trade back to $90, $80 with no crazy change in the business as we saw from 120 to 100, I will definitely be adding a lot more to my position and averaging down. Alright, next, the third smallest holding in my portfolio. I'm down 17% on the holding right now. It is Nike, stock ticker NKE, which is another really weird position in my portfolio. It's a very small holding, but it's also a very odd one, as I just mentioned. So basically in 2021, I bought Nike knowing nothing about valuation whatsoever and just assuming the brand would grow over time. It was definitely a big qualitative play. I bought it at $144 and it's gotten down since then, and it's been a really bad performer over the last 5 years. Now, some people do like to judge their investment thesis over the 5-year chart, and if it goes up and to the right, it's a good stock. But with Nike right now, I am seeing some struggles for sure. I have been buying Nike definitely in the $85, $88 range, and that's where you've seen me average down as of recently, but I've been holding on as of late. Nike's an honestly really weird one. The growth has definitely slowed a little bit, but the brand is undisputed, and I think it's more of a value/growth play at this point. I'd love to see them buy back shares at these lower prices. They failed going direct to consumer, and it appears to be hurting them a little bit right now. But at the same time, with a company like Nike, their brand is one of the strongest in the entire world. It's one of the only companies that can make a $20 shoe, put a price label of $300 on it, and have the shoe sell out in minutes. It is that kind of power, and Nike's also one of the only fashion companies, unlike Crocs, which has proved staying power in the 2000s and through decades. But with Nike, I'm only at a 17% loss right now. It's really no crazy loss in terms of dollar amount, but it's absolutely a question mark in the portfolio, and it's a bit of a turnaround play at this point. Likely, I'm going to continue to hold an average down. The next company, which is down 14.5% and is the smallest holding in my portfolio, is Nexair Energy. Talk about another weird company. This is the smallest holding in my portfolio right now, and I've actually been trimming it recently at a tiny gain slash flat loss. Compared to my cost per share, at least, I was buying the company in really weird stages, like $71, $74, and also maybe like $90, but it's definitely just been a company that's just sending in the portfolio. Honestly, with this one, I'm more likely just to sell out of it pretty quickly. It's really like a $6 or $7 loss. It's nothing that wild. In the last few months, they've had a really nice recovery in stock price, and I've used that to take advantage and trim out and put into some higher conviction positions. Like I sold out of it a week or two ago, and I just put the money right back into Visa, where I think it's definitely going to get a better return over the long term. With Nexair Energy, I kind of just bought it because it was a growth utility, and at the point in my investing journey when I bought it, I was in that stage where I had to get diversification in every sector. I thought with the Biden administration, this would be a good play. At the end of the day, it's just an underperformer, as most utilities are. Utilities are solid if you're in your 40s, 50s, looking for some stable dividend income, but it's definitely not the right stock for somebody my age. Likely not going to be in the portfolio much longer. Another big concern with this company is debt. Now, obviously, utilities do take out a lot of debt, but this is a company that spent a lot of money on capital expenditures and is increasing their dividend at a really rapid rate, especially for utility, at 10% a year, which they reaffirmed through 2026, I believe. Alright, I want to thank the sponsor of today's video, the Delta app by eToro. Now, you guys know I've been partnered with Delta for a little bit here now on the channel, but they have an exciting new update to their app. From behind the scenes testing and me personally using the app myself, I can say that this is definitely an upgrade from the previous version. The interface is definitely a lot cleaner, and it makes it even more convenient for me to see when my favorite stocks are up or down for the day. It's the best kind of adrenaline rush, and the adrenaline rush that you can get completely for free, and they also have the option to track crypto and NFTs if that's the kind of stuff that you're into. They also have a new Discord community as well where you can get access to new features before anybody else. Now, since Starbucks is the only company that I'm majorly tracking in this app, it even gave me a personal recommendation and a bit of a warning that my portfolio is heavily consolidated into consumer discretionary. This is so sick, and if you're a beginner investor, it can definitely maybe open your eyes to something you haven't been seeing before. Thank you once again so much to Delta. You can download it on iOS or Android, the link's in the description. Thank you, Delta, and on to the video. Alright, and lastly, my 8th largest holding in the portfolio, sitting at a 14.3% loss, and currently one of the biggest dollar amount losers in the portfolio. It's of course Realty Not Reality Income, and this is one of the stocks that I most shit on in this channel. Now listen, I agree, it completely makes no sense that I'm holding this company, especially at 18 years of age. It's going to underperform, but listen, since I bought this company in 2020 and 2021, it really hasn't changed that much from a business perspective. Interest rates are obviously the huge reason that this and other REITs are trading down right now, and I think it would be irresponsible for me, especially as a long-term investor who buys an asset for the long term, to sell out right now at a historical bad time for interest rates. I talked about this in my Vici video. This is a company that is not going anywhere anytime soon, and I will gladly be patient. I'll wait with this company. I'll stay on the sidelines. I'll reinvest my dividends every month with them at a 5 and 6% yield, and I'll wait for interest rates to recover. And eventually the stock price will follow, and I will sell out hopefully at a gain. At this point, it's just about being patient with the company. I said the only way that I'd eventually sell out of my realty income at a loss like this, or potentially earlier than I normally would, wait for a recovery, is opportunity cost. If I see a company that's a no-doubter, like Visa goes to $200 or something, I'm going to absolutely be reallocating that capital back to a more higher conviction holding. Realty income's not going anywhere. It's an absolute slow grower. Absolutely recovery play at this point too, so I'm just going to be patient with the company. Alright, another honorable mention, not in the portfolio anymore, but one of probably the biggest loss I've ever had dollar amount wise, 3M. That's just to show why you don't buy companies you don't 100% understand. I hope you guys appreciate this transparency, and overall just buy the S&P 500. That's all I have to say. Alright, thank you guys for watching. Smash the like button, subscribe, and do Dividend Stocks Hot Drugs. Have a good one.